Hey there, everybody. Thomas Wood with Basecamptrading. It is Tuesday, May 30th, a day after Memorial Day, and we're going to take a look at soybeans, and we're going to talk about what we call multi-timeframe analysis and how that works and how you use it within the context of price action setups. So with beans here, what we had is we were looking at our longer time frame charts, our weeklies, and we were saying, okay, we're breaking down. We broke out of this consolidation here. We're overall on a downtrend, and then we triggered a bear flag a couple of weeks ago. All right. Then the first step from that bear flag that we've talked about in many of these daily videos before, first step is, can you break through the low of that flag? And then once you're through there, you should be in the okay to continue to push lower. Well, if you look at this, you're going, all right, well, that's a whole lot of risk trying to enter here and place your stop all the way up above. So the way that we lower our risk and increase our potential reward is we find a setup on a longer time frame chart, and then we drill down to a shorter time frame chart to actually time your entry. And today in the trading room, we had a really good entry in soybeans that played out perfectly fine. We also had one last week. Actually, I had a couple last week. But what we did is you take, within the context of that 240-minute or that weekly setup, we're going, okay, the weeklies say it should continue to push lower. You drill down and you find something on the 240s to time your entry. So for example, here you had a micro trend break on the 240s, which gives you a very nice entry right into the breakdown. Then you have your bear flag here on the 240s, which gives you another entry that was on Friday. Then you have the entry that we had today, which was another bear flag on the 240s that triggered as soon as you broke through the lows or the previous bar's low on that 30-minute price or 240-minute price chart. So as soon as it broke down below 923.5, that gives you your short entry. Now, what this does for you, because you're operating within the context of that weekly setup, is we now expect that market to move much further. And one of the things I always teach people is your goal as a trader is to get as high of a reward risk, or should be to get as high of a reward risk as you can, that also matches with your win rate. Okay, so it's a balance between win percentage and reward risk, how much you make on your winning trades versus how much you lose on your average losing trade. Well, one of the ways to increase reward risk is by increasing the amount of money you make. Okay, so how do we do that? Well, we look at a longer time frame setup where we expect the market to have a big move, and then we drill down, decrease our average risk by drilling down to an entry, but we let the market, we let that move run until the target on the longer time frame is hit. So for example, you're entering on a 240-minute price chart with soybeans, but your target is based off of a weekly price chart. So you're making a much larger reward off of a much smaller risk because your entry was from a smaller time frame. And the smaller the time frame you get to, the smaller the amount of risk you're going to have on each trade. However, there's a trade-off, because the smaller time frame you look at, the more false signals you'll also have. Okay, so keep that in mind. Look at longer time frames, identify where the big setups are, where the market moving setups are going to be taking place. Then drill down to the shorter time frames to actually time your entry so that you're getting in at an ideal entry level with minimal risk, and then you maximize that reward. All right, that's all I have for you for today. I will see you in the trading room bright and early tomorrow morning. Don't forget to click that link to subscribe. And until next time, happy trading.